Alright, thank you guys for clicking on this week's video. Today we're going to go over the box theory trading strategy. Now, as you can see with this trading strategy, it's pretty much exactly what it says. You create a little box to where the stock is basically trading at. So it'll bounce between, like, let's say $45 and $50. That's where the box is. And every time it breaks through into a new box is when you want to buy the stock. Because the general idea is, since it's a stock that keeps going up, you want to get into when it gets into a new level, preparing for it to jump up to the next basically price point bracket. That's basically what the strategy is. But before you click away from the video, there's a lot of things I want to explain about this and how you can probably use it better, and some other things that you should look for when doing this. So the first things first is, it looks really simple, right? With this example that I've shown, basically the stock is growing up and it's clearly within a nice, easy to see box. Problem is that I don't like is that you buy the stock whenever you break through into a new box. So you're basically buying it at its highest point once it hits that new box. Or maybe not the highest point, maybe when you find what way like varies in between, you buy at the low end and then you wait for another breakout. In my opinion, it's probably better just to buy and hold if you're going to do this instead. But in case you're not doing that, it's more of a swing trading method. The things I would look for is look for the price to stock volume ratio in a sense. So for example, like if it breaks through into a new bracket, but the volume's been basically the exact same thing throughout the week, you can assume that the stock is just gradually going up. However, if you see a huge influx in the volume, and let's say it's a ton of buying pressure and it shoots the stock way up, as soon as the volume starts regressing and coming back lower, you know that typically the bears are probably going to start regaining control of it. Or maybe not the bears, but at least like the rally isn't going to extend anymore and probably drop a little bit. And you can either sell the stock at that high point or sell off some of your shares, or just hold on to the stock in general. However, the other major issue I have with this is when we take a look at this example, it's very hard to tell exactly where the boxes are on this graph. Now, obviously, to make it easier, you just decrease the amount of time allowed into the graph. So for example, instead of doing, I don't know, 5 years or 1 year, break it down to like 6 months, 3 months to a month, and it'll be a lot easier to see where the box is. However, the downside to that is whenever you do that, it's not as accurate in a sense that when you have a bigger time frame, you know those results are a lot more guaranteed. So like if you see on the day range, it's trading between $50 and $51, but on the monthly range, it's trading between 50 and 55. So you know the top is more like 55 and not 51 where the breakout point is. So in my opinion, the pros about this, it's more of like to tell where I would put my stop loss order at. So if I see like, okay, the box is between $50 and $55, right? I would put, hey, if it drops below $50, sell my stock automatically. I would personally use it more for this sense versus as whether I should, be buying into the stock. But that's just my personal opinion. You guys can use this trading method however you want. So I hope you guys liked the video. Leave a comment in the comment section below on what trading strategies you want to see next, or in the future, or just in general, or any type of videos. But as always, thanks for watching. Remember to leave a like, comment, and subscribe for more future content.